Going to record. Hello, it's Greg Harrelson here with Century 21, the Harrelson Group, and I wanted to invite a guest, onto a Zoom call today to talk about risk and how do you factor in risk. Whether you're thinking, if you own a piece of property, maybe on the ocean front, and you're wondering if you should sell it, maybe you're getting a decent return. You don't really know how to factor in risk and volatility into the equation. And so I thought the best way to have these conversations is to invite a financial advisor, onto the to a Zoom call and just kind of freely talk about this subject and see what we can learn and how investors in the security world evaluate risk, returns, and make financial decisions on whether or not they should buy, sell, or maybe reposition, buy and sell. So let me welcome Jeremy Finger with Riverbend Wealth Management, local financial advisement firm here in Myrtle Beach, South Carolina. Thank you, Jeremy, for joining us.
Thank you, Greg. I appreciate you having me. Thank you.
Yeah, so I kind of prepped you a little bit ahead of time just to kind of share with you what I had in mind. So let me kind of set up the scenario. Obviously there's investors that own property, or maybe just owners that have second homes along the coast, maybe in Myrtle Beach and other coastal areas of South Carolina, where they're thinking they want to sell their property, but when they look at it and they look at all the expenses, the holding cost, the rental management fee, and they, maybe they own a property that's worth $200,000. They own it in cash, but they're only making, say, $4,000 a year on that particular property in positive cash flow. That's a very common scenario, by the way. Mm-hmm. It's $4,000 off of $200,000. So could you just walk us through, first of all, what's the annualized return on that? If you got a $200,000 asset and you're making $4,000 a year after all expenses, what's the annualized return? Or is there other factors that we need to factor in to consider annualized return?
Okay. All right. So that's a great question, Greg. And thank you for bringing this to your attention. I have to go over this with my clients often, not only with the stuff they have with me, but with other investments like real estate. But a $4,000 positive cash flow on a $200,000 investment is a 2% return. Mm-hmm. And so what you do is you take 4,000 divided by 200,000 to get 2%.
Right.
And as far as that is concerned, some of the things that I would ask you, as far as risk is concerned, occupancy rate, HOA possibly going up, multiple different taxes being assessed, damage to the property. There's all kinds of variances that are there that a homeowner would know. In my world, okay, a risk-free return would be the U.S. Treasury. It is almost really for the world, a risk-free return. So anything over and above that, you need to get compensated for. If you're going to take on more risk, you need to get paid more return. Okay. Yeah. So that's how it is in my world.
Yeah. So okay. And I'm glad you're kind of moving in the direction of what I want to talk about here. So let's go back to, though, it's a $4,000 return off of $200,000, which equates to 2% annualized return. That's so nice. A lot of times, and of course, I don't really have an opinion, and I'm not going to share an opinion on if that's a good return or not a good return, because I think every individual, that's probably slightly different. I know when you and I might be talking about investing money, I talk to you about, I'm 50 years old and I want to accomplish this. So you may say to me, based on your situation, your risk should be about this level, versus somebody else could be younger, they may take more risk, or somebody could be older, they may take less risk. So That's risk right. is definitely a personal conversation. I know you've taught me that, over the years. But what I want to share with this is there's condo owners that sometimes maybe a little bit older, they're making a 2% return on their money. And I look at it and say, gosh, you know what? I wonder if they should be in an investment that has so much volatility, meaning they like the 2%. They're okay with the return. Right. But then all of a sudden something happens. Maybe rental occupancy goes down, and now all of a sudden that 2% return is no return.
Right.
or these special assessments come on, and then that 1 year they are assessed $2,000 or $3,000. That wipes out the majority of their return. So when you're in that situation where maybe you're a little bit older and at a time that you might be thinking of taking less risk, how do you factor in volatility from a condo ownership standpoint into your rate of return to
Okay.
determine whether or not you should reposition your money? Because we can talk about other places to make money in real estate, but how do you factor in risk?
Okay. Okay. So there's, okay, how to factor in risk. So factoring in risk in my world, and I'm going to translate it to real estate, but in my world is a Sharpe ratio. And I mean, without getting too technical with it, is that if I'm getting 2%, it better be pretty safe, fairly. If I can get 1% on the U.S. Treasury, for example, getting 2% is really not that much more. So it better be relatively safe. Okay. In real estate, I would imagine with all the different factors you just described, that's a lot of moving parts that has to happen right for that person to get 2%. Is that correct?
Yeah, yeah. It's basically it's very sensitive. You know, that 2%, you know, there's a lot of factors that the owner does not control, that it can just randomly happen. And then
Right.
all of a sudden it could go a little bit higher, or it could vanish.
Okay. Okay. That being said, the more factors that change the outcome, the higher the risk. Okay. And so, I would imagine that oceanfront real estate, it being, tied to the economy and things like that, amongst many, many, many other factors, is pretty volatile. And to take on that type of risk for a 2% return is something that I personally wouldn't do, and I would not advise my clients to do.
Understood. Yeah. So you said something interesting. There's so many factors. So like on an oceanfront a complex, a lot of times they have the ability to say, hey, it's been 3 years since you've changed your furniture. You need to redo all the furniture now. And that furniture package is $10,000, $8,000, whatever it is. Could knock out a couple years of return. That's something you can't control, versus maybe if they were to sell and reposition their money into maybe a single family home, then they could immediately get a better return on their money. And there's less factors. They make all the decisions. So nobody can assess them. Nobody can say you've got to change out your furniture. You may not be shut down and lose rental income because of a hurricane, things like that. Is that what you're talking about?
Absolutely. That's absolutely what I'm talking about.
Okay.
I mean, if you reduce the number of factors that can change your return, you reduce the risk.
Okay. Got
There's
it.
one other thing to keep in mind as well, Greg. I do want to throw this out here, is that in a $200,000 example, let's just suppose it's free and clear, that person has a $200,000 asset. Okay. And $200,000 in some people may represent 50% of their investable money, or which is that is a huge amount of risk taking on that may be taken for 50% of their money. Now, 200,000, maybe 1% of someone's money, but they have to have $20 million. So,
Yeah.
so that's also a factor, is what dollar amount does this represent in someone's life as well.
Man, that's, I tell you, that's a new one for me. We've had a lot of conversations on how to evaluate returns, rate of returns in real estate investments. And I try to emulate the financial world as much as I can when it comes to my interpretation or analysis of it. But that is a new one right there. I also want to say something else here, and when we're talking all financial. We're talking as if this condo is nothing more than a piece of paper, right? Like it's a stock.
Right.
But the reality
It's not. It's way more than that.
Yeah, it is. And there's a lot of people that are buying these properties and they get to use it for a few weeks. So in their mind, they have a place to come down and live. They have for 2 weeks or stay down. They've got family that they can share their condo with. They got workers they can send down here, friends that they can let use the property, at a for free or at a discounted rate, and they get a lot of value out of that. And I don't want to discount that, because there's emotional returns and there's financial returns. We
Yeah.
are only talking about financial returns here. So that doesn't mean everybody needs to go out and sell their property. It doesn't mean everyone needs to go out and start buying more property. What it does mean is that when you're buying or when you're owning, you also want to look at the emotional return you're getting, because in Myrtle Beach, what happens is a lot of people will buy a condo and then 4 or 5 years later, they're not really using it anymore. It's kind of ran its course. And then they keep it hoping that financially it'll make sense. So they bought it for the emotional returns, but then the emotional returns run out and it turns into an investment, and they're evaluating it from an investment return. What I try to tell people is when the emotional returns are no longer there, then you have to start looking at it as it's an investment, and this conversation comes into play. So, you know, I just wanted to, for those viewers out there, I wanted to acknowledge that this is a financial conversation, lots of logic. There wasn't much emotion in it, but I also don't want to ignore that when you own a property, if you're getting use of it, there's a value in the experience, in the pictures that you get to take at Thanksgiving with your family, the birthday parties that you have in your condo. Let's not ignore that that is additional value. Does that make sense, Jeremy?
Yeah, very good point. Absolutely good point. You know, the negatives would be as HOAs come up and property gets damaged. That's a negative respect to owning property. And then of course the positive to owning property is all the things you just described.
Yeah.
And the positive things that you described is something that is hard to quantify.
Absolutely. I mean, I've got things that I own that make no sense financially, but make every bit of sense emotionally and the experience for my family, and I won't sell them for anything. So, you know, we just want to understand both sides of the spectrum. So before we get off, one of the real things that I kind of took away from the conversation with you is this, is that the more variables there are that can influence the annualized return, that you, especially variables that you don't control, the more variables there are, the more risk that you're exposed to.
Absolutely. And the depth of those variables as well.
The depth of those.
Meaning that, like, if like you just said about $10,000 package for furniture, that's an enormous dollar amount versus the amount of income they get.
Yes.
After 5 years. That's a huge depth of a variable. Okay.
Understood.
But let's just say you could buy furniture for $500. That'd be a small variable.
Yes.
To give you an example.
Okay. Well, good. Well, you know, again, thank you so much, Jeremy. This is Jeremy Finger with Riverbend Wealth Management, here to just help us make some sense out of the financial side of real estate investing. So, Jeremy, thanks a lot. I know we're going to do quite a bit more of these.
All right. Thank you very much, buddy.
You're welcome.